Welcome to the Deep Dive. Today, we're looking into Twin Disc Incorporated. Their 2025 annual report just came out. Now, this is a company with deep roots, right? Started way back in 1918, Milwaukee. But today, they're global. Heavy industrial stuff, marine, defense, power transmission, operating in, 13 countries now? Our mission today is pretty straightforward. Figure out how a company can have this massive revenue growth and yet somehow end the year with a net loss. The report itself calls this a, quote, transformative period. Lots of moving parts. Acquisitions, defense contracts, and this huge push into electrification.
It is a complex picture, isn't it? Because you look at the top line, the sales figures, and they look great. Net sales jumped 15.5%, hitting $340.7 million. And that's driven by, solid demand in their usual spots, marine propulsion, but also these big acquisitions they made recently.
Okay, but then the bottom line.
Exactly. Despite that strong revenue, they reported a net loss. Almost $1.9 million for the fiscal year. And that loss, well, that's the key, really. It's not like operations fell apart. It's more like the price tag for this big transformation they're pushing through. We really need to dig into what they actually bought, strategically speaking, and where they invested for the long haul, eating up those short-term profits.
All right, let's unpack that transformation. Let's start with the acquisitions, since they drove that 15.5% revenue jump. The report makes it clear two big deals were the main engines here. First up, Katsa. That's the Finnish company they bought back in May 2024. They make custom power transmission parts, high-quality gearboxes, and in its first full year with Twin Disc, Katsa added, let me check, $39.1 million in revenue. That's substantial.
Yeah, and COTS is more than just cash flow. It's really a technology booster for them, especially in Europe, sure, but also, crucially, for the next-gen gearboxes they need. Their know-how in custom engineering. It fits perfectly with this shift towards complex hybrid and electric drivetrains. Those things need precision.
Okay, makes sense. Then there's Kobelt, the Canadian manufacturer. They picked them up mid-year, February 2025. Kobelt brought in less revenue initially, about $4.9 million for Q3 and Q4 combined. But you mentioned their strategic value seems, bigger than that number suggests. They do steering, controls, braking systems, mostly marine.
That's right. And Kobelt, get this, they've been around for over 60 years. But their really unique thing, it's their vertical integration. They actually have their own foundry. Plus machining, testing, all in-house. Now think about that. Running your own foundry today, that's rare, it's expensive, but it means total control over the metal quality, the durability. Absolutely essential when you're building parts for, say, military ships or these new wave energy projects, high-stress stuff.
So it wasn't just buying market share. It was buying specific capabilities, quality control built in.
Precisely. And you look at how the CFO talks about it. The strategy isn't just gobbling up companies. They explicitly mention honoring the, quote, multi-generational family culture of these places.
Yeah.
They want to be seen as a partner, not just a buyer. And that's smart, right? Helps keep the key people, the knowledge, on board, ensures these acquisitions actually fuel that long-term vision, not just get stripped for parts to save a buck now.
Okay, that long-term vision, that leads us neatly into their two big strategic pillars. Let's talk pillar A first, powering global defense. The report highlights growing demand here. Modernization efforts, NATO readiness sounds like a big driver.
Oh, absolutely.
Yeah.
The whole geopolitical situation has put a premium on reliable military gear.
Yeah.
And Twin Disc is positioning itself as that trusted supplier.
Yeah.
We're not talking about standard off-the-shelf marine parts here. These are heavy-duty, specialized driveline and transmission systems, built for the absolute worst conditions. Imagine Navy ships in rough seas, NATO patrols needing perfect reliability, military vehicles chewing through tough terrain. The kind of durability you get from specialized components, like maybe from Kobelt's foundry or Katz's custom gears that becomes a core selling point for defense contracts. Reliability isn't just nice to have there, it's everything.
Right. But, okay, if they're leaning into defense, which often means traditional engines, fossil fuels, how does that square with Pillar B, leading the shift to electrification? Are they just hedging their bets, or is the plan really hybrid?
Well, it looks like a calculated move. The report is pretty emphatic that the future is hybrid and electric. And they seem determined to lead that shift, not just react to it. And they've got market data backing this up. Apparently, hybrid inquiries, already 18% of all the application requests they get.
Wow, 18% already.
Yeah, so the shift is definitely here, as they put it, and they're answering with some specific innovations.
Okay, let's hear about those innovations. This is where the engineering gets interesting.
For sure. Let's start with something called the Elite Propulsion System. This came out of teamwork between two of their divisions, Rolla, who does propellers, and Veth Propulsion. Veth specializes in counter-rotating propellers, CRPs.
Okay, wait. What's a counter-rotating propeller, a CRP?
So imagine instead of one propeller, you have two, mounted on the same axis but spinning in opposite directions. What that does is recapture some of the rotational energy in the water that a single prop just wastes. The result, better fuel efficiency, way less vibration and noise, just smoother, greener sailing. It's high-tech stuff for valuable ships.
And this connects back to the acquisitions, right? Leveraging those new capabilities for this electric pivot.
Absolutely. Katz's custom gearbox expertise that feeds directly into the Katsa 2 L550 gearbox. It's specifically designed for electric and diesel-electric systems, and we're seeing it deployed already. It's going into hybrid cargo ships for Holland Shipyards Group. And those ships, they're expecting fuel savings of like 35% to 50%. That's huge. A real measurable sustainability win.
35 to 50%?
Wow.
And Cobalt, the steering and control guys, they're involved in the clean energy push too.
Yeah, and this one surprised me a bit when I read it. Cobalt is working with Carnegie Technologies Spain. It's part of an EU project called Achieve. They're engineering key drivetrain parts for something called the CEO Wave Energy Converter. It's fully submerged, uses wave motion to make power. I mean, think about designing parts for a giant machine working deep underwater, converting waves to energy. It just shows how broadly they're thinking about integrating these acquisitions. It's taking them right into specialized renewables.
And they're backing this up with actual brick and mortar investment, not just R&D on paper. They put money into a dedicated production space at their Racine headquarters just for hybrid and electric systems.
Yes, and crucially, they expanded their R&D setup too. They added a custom test bay, and maybe the most telling part, a brand new fire-rated battery testing building. Yeah. You don't build one of those unless you're dead serious about handling high-voltage systems safely. It lets them simulate the toughest real-world conditions for batteries on ships or heavy equipment. Make sure everything's safe, reliable before it goes out the door.
Okay, so that level of capital spending, the new building, the upgrades, plus the immediate needs of Katsa and Cobalt, that starts to explain the net loss, doesn't it? That infrastructure investment sounds like a big reason.
That's exactly it. That net loss is, in large part, the cost of this transformation. Acquisition costs, sure, but also that big jump in capital expenditures. What was it, $15.2 million this year, up from $8.7 million last year.
Big jump.
Huge jump. They basically chose to invest heavily right now to lock in a strong position for the future.
Before we get into the risks that come with spending like that, let's touch on their global sales mix. The diversification seems to be working, helping buffer against weak spots.
It does look that way. Europe saw a massive 40% sales improvement. It's now 41% of their total sales, up from 33%. That's the direct impact of Katsa coming online, plus strong demand for VETH products.
Okay.
On the flip side, Asia-Pacific sales dropped 20%,
Yeah.
mainly due to weaker demand for oil and gas transmissions in China. So yeah, the downturn in one region was largely offset by the strategic gains elsewhere.
And operationally, demand seems solid. The order backlog looks healthy.
Yeah, the 6-month backlog grew 13%, ended the year at $150.5 million. That signals ongoing customer confidence, even with all the economic uncertainty out there.
Right. But the challenge now becomes managing the finances, the constraints that come with this aggressive growth and spending. The report goes into some detail on the risks.
It does, and they're quite specific. For you, the listener, these technical bits matter because they basically set the guardrails for the company's next moves. For instance, under their updated credit agreement, they have strict debt covenants they have to meet. There's a limit on their total funded debt to EBITDA ratio. It can't go higher than 3.60 to 1.0.
Okay, break that down. For someone not deep in finance, why is that specific ratio important?
Okay, think of it like this. The bank is saying you can only borrow up to $3.50 for every dollar you earn before interest, taxes, depreciation, and amortization.
Yeah.
It's basically a debt ceiling imposed by the lender.
Gotcha.
It limits how much further they can push this growth strategy using borrowed money for more acquisitions or big immediate spends. Keeps them disciplined. They also have another one. A fixed charge coverage ratio has to be at least 1.10 to 1.00, meaning for every dollar they owe in fixed payments, like interest, they need to generate at least $1.10 in cash flow to cover it. These aren't just numbers on a page. They're real constraints on how they operate.
So the pressure is on to execute perfectly. Integrate those acquisitions smoothly, keep sales strong, generate the cash needed to stay within those bank limits.
Exactly. And that brings up the final big risk, integration itself. They bought two complex businesses, Katsa and Cobalt, both with long histories, family roots. Getting the full value out of the intangible stuff customer relationships, that specialized tech know-how, finding ways to cross-sell, that's a tough ongoing challenge, and it directly impacts their long-term success.
And we can't forget the external stuff either, given they operate worldwide.
No, global trade issues are always lurking. Currency fluctuations are a big one, especially the US dollar versus the euro, now that Europe is such a big slice of their sales pie that swings can really hit profitability. Plus, there's always the worry about rising commodity costs. Steel obviously is huge for them, and potential new tariffs. These outside factors can make hitting those debt covenant numbers much harder.
Okay, so let's synthesize. What's the big picture from this 2025 report? It sounds like a company with a century of history making a very conscious choice. Sacrifice some profit now to build a foundation in two critical future markets.
That really is the core takeaway. They use those acquisitions, Katsa for the advanced gearboxes, Cobalt for the durability, and that unique in-house foundry to grab major capabilities. They've clearly staked their future on two things: military modernization, and maybe even more importantly, leading the charge into hybrid and electric propulsion. They're doing it through product innovation like that Elite system and through serious infrastructure spending like that fire-rated battery building we talked about.
Which leaves us with a pretty interesting question for you, the listener, to think about. We know the electric ship market alone is forecast to basically quadruple by 2032. Twin Disc is clearly betting big now, building the infrastructure, engineering these highly customized systems for marine and defense. So the question is, how fast will that global demand for sustainable, high-power solutions force every heavy machinery sector, not just ships, but mining gear, construction equipment? How fast will they all have to adopt these kinds of specialized, customized drivetrain technologies? It feels like the future of heavy industrial power is really locking into customization and electrification, doesn't it?